Welcome back to Market on Close. I'm Caroline Woods. We have 10 minutes left in the trading day. It's time for the big picture. Let's welcome in the team from Charles Schwab. Joe Mazzola is head trading derivatives strategist at Charles Schwab, and Kathy Jones, chief fixed income strategist, Schwab Center for Financial Research. Joe and Kathy, great to have you both here with us. Joe, let's start with you. Taking a look at the major averages here, we lost the S&P for a second, but back in positive territory right now, just kind of bouncing back and forth across the unchanged line. Dow and Russell are lower. What do you make of today's action, or really kind of lack thereof?
Yeah, I mean, it makes you wonder how much of the move was kind of front-loaded on Monday when we got the announcement that there was kind of a moratorium on the tariffs between China and the U.S., or at least the 90-day pause, if you will. And so, how much of that upside bullish momentum was due to that day? Because we have started to see it fade a little bit. Now, what I will say is this: 5,900 could be a bit of a resistance level. There's a good amount of open interest there for the option traders out there, especially that are expiring this Friday. And kind of what that means is that when you have that open interest, it can act as a magnet, kind of pulling it back and forth between that strike level. And when you have that, plus you have a VIX that has got down below 20, you might see the market makers just kind of put their hands in their pockets and just kind of see what happens without kind of forcing the issue either way, just because it's not pricing in a big move at this point. And we got pretty good sentiment earlier this week from the CPI data on Tuesday that gave us a little bit of a boost, but we haven't really kind of broken up above that level of 5,900. And so it just kind of makes you take a step back and say, all right, what's it going to take to get it up through this level? We had, there's decent trade data today that didn't get it up through there. So, we'll have to see as the week progresses if we can get and push through that with a really good thrust that takes us up, potentially to 6,000.
So, Joe, 5,900 is a technical level, but can you make the case that the fundamentals are even strong enough for the market to continue to move higher?
So that's another good question, and here's the reason why. Now we're back to a 22 PEs, right? So when we were trading down around 4,800 in the S&P 500, you could make a case that earnings had held up well, which gave a little bit more support to some upside. Now here we are, earnings have held up well. What is kind of the direction going forward? Are we going to see some positive revisions? Because it's only been negative at this point, at least from the analyst community. With a 22 with a 22 PE on the S&P 500, you are kind of once again in that price to perfection level, and that's kind of a bit of an inflection point.
Okay, Kathy, bringing you into the conversation, taking a look at the 10-year yield, it's ticking higher today, back above 4.5%. What's behind that move?
It just sort of crept higher quietly today, and I think it's more the path of least resistance is higher. It's not that there's any particular news to make it go up. It was simply that there wasn't anything to make the yield go down or stay steady. We're still looking at tariff rates that are probably 5 times what they were prior to the whole trade war starting. So there's an expectation that we're going to see some of those numbers flow through and inflation down the road, or at least a risk that that's going to happen. We don't have the Fed coming to the rescue. They've been pretty clear that they're going to be on hold for quite some time. And so, the market's just sort of churning here. But absent any particularly good news, you'll just continue to creep higher.
So, Kathy, if the path of least resistance is higher, how much higher could we see the 10-year yield go?
Well, I think we will have to see some data to push it a lot higher. You get to 560, 465, 475. I mean, you need some negative inflation news or some sort of economic data, I think, to push past that. But to get yields to come down, you're going to need to see, some sort of really good inflation numbers, maybe some weak employment numbers, and maybe a resumption of foreign interest in the U.S. Treasury market. There's been this backing away from U.S. assets, and especially the Treasury market. We'd have to see some enthusiasm coming from abroad.
Joe, speaking of data, the latest inflation data actually paints a pretty good picture, certainly not worst case scenario. We'll get PPI tomorrow. We'll also get retail sales, Walmart earnings tomorrow. It seems like the consensus is that just the worst case in general is now off the table. Do you think that that is correct, or do you think the market could be getting a little bit ahead of itself?
I would say it's possible the market's getting a little bit ahead of itself, and here's the reason why. The data that we've seen from CPI hasn't really had much of the tariff flow into it, right? I think that's probably will be a little bit more indicative of what you see in the next report that actually has some of the May data in there. So that would be something I would kind of keep an eye on. And I think the other thing to just be kind of mindful of is look at the move we've had off the bottom. How much of that, potential good news has already been priced into that good news in terms of, what new trade deals could mean, good news in terms of, whether or not we push back our odds for a recession. You've seen a lot of companies already start doing that. I think at some point, we're going to have to kind of recalibrate and say, let's get back to kind of looking how our earnings have unfolded, what they look like going forward, and is the market priced appropriately for what could be happening in the next 6 to 8 months.
Kathy, it doesn't seem like the bond market's pricing in a recession, at least. So is that at least off the table?
I think for the time being, fears of recession have been pushed back because the agreement so far, the delay, the 90-day reprieve on tariffs with China has certainly helped lift spirits and revive the idea that the economy can continue moving along at a pretty good rate over the next quarter or so. It doesn't clarify what happens after the 90 days. We still have that hurdle to get past. But for now, I think the bond market is saying, okay, it's back to business. Maybe not as usual, but back to business. And the economy will continue to tread water at least.
Okay, we'll leave it there. Kathy Jones, Joe Mazzola, Charles Schwab, thank you both so much.